Good evening, and it's Friday night again. Let's wait for a few minutes before everyone get in, and we will just start on today's free classes. But before that, let's give a little bit warm up and some waiting time for the others to get in. We will start on 8 p.m. sharp, so 2 minutes later on, then we will just go on into the topic. Okay, it's about time. Then we will just start on today's lessons. Wow, it's already lessons 8 for the whole series. And let me just give a little bit introduction of my own before we get started, in case that there is others that they're new joiner for these sessions. My name is Jun Lo, and I have 4 years of experience in fund management and 2 years specialized in quantitative trading, which I built my own custom algo board, and then I have my own strategy to help the others to just manage their fund and then trade in the financial market. And my annual return for the whole fund management career will be around 26 to 33%, even though it might not be huge for when you're comparing to some very significant, some fabulous result like few 100x and all those, but I'm very satisfied with the result, as I want to achieve a stability in the income generation instead of just getting wealth in a rocket money way. And for the first lessons, we have talked about the basic theory of the options, like how the options work and what is the options. And when you get in, how do we calculate the premiums, and also how do we calculate the P&L, and what is the pro and cons, the characteristic and the trial of the options when comparing to the other financial instruments, when like futures, index, CFD, and all those. And the most fabulous part about option is you can become a seller when comparing to the other financial instrument. In the other financial instrument, even though you can go long or you can go short, but you are actually the buyer in both situations, which you pay some fees to the platform, to the brokerage, and then you get into the position to bet on the directions. But when it comes into options, we can actually become the seller, which we collect the premium upfront, and then afterwards we will just let the result run in the directions. And since the market have a rules of 80 to 20, which means that 80% of the people get into the market, and they are the loser instead of the winner. There are only 20% of the the investor or trader can become the survivor of the market and make some money from the market. Meanwhile, the majority of us actually doesn't make a profit from the market, and then we may suffer some losses in the market. So if you become a seller comparing to the buyer, what can you do is that you can actually outperform the market, because majority of the player in the market is actually losing, and where's the money goes? It goes to the seller side. So becoming a seller actually bring you a very high win rate when comparing to becoming a buyer. But there is pros and cons. If you are the buyer, you actually can bet on the directions, and then you can get a very significant gain. It's like a toto, and it's like a casino. If you are going to look for a very skyrocket result, then you need to become the buyer. Meanwhile, when you're becoming a seller, the maximum profit that you gain is actually just the premium that you collect, and you are not getting anything above it. But the keys to becoming a seller is actually you can get a very consistent and high win rate when you're comparing to becoming a buyer. So the consistency and the high win rate is the key. And these two things will also make you feel better in your psychological way, so that you can survive longer in the market. And in the first lesson, we already talked about the theory and the calculations. We have bring into the insurance cases for better understanding and illustrations. And in the second class, we talk about the beauty of becoming a seller, which means when you become a seller, how do you make use of options to just replace the traditional buy low and sell high? When you're going into the store, you buy low and sell high, and there's just a two click button to execute all those. But if you utilize the options, no matter you can get into the position or not, you will make a premium out of it. And that is a very good way, an alternative way to replace the traditional buying and selling in the stock market. And that is what we talked about in the second lessons. And in the third lesson, we have talked about the mainstream and the type of analysis in the market, which we have the fundamental, the technical, and also the news type. And we just briefly go through it, and then we didn't go into the detail. Meanwhile, we will just talk into how to do a very deep fundamental analysis and technical analysis in the future. And in the fourth lesson, we have talked about the grid value, which the grid value will determine the options value. So the grids actually help us to make a better decisions on how do we choose a perfect, a most suitable options for us. So if you are very interested in those topics, you can just go to the record list, and then you can just check on the record. And I didn't quite remember for what is the sessions afterwards, but in today we are going to talk on lessons number 8. And once again, I will just declare that in this lesson, in the whole series, we are not going to upsell you any courses. We are not going to sell you any courses, and this is 100% free. I'm not going to collect any of your personal informations and your money. So if there's someone else come to approach you and they want to collect your informations or money, that must not be me. So please be aware of that. Okay, so many people come into the options. Be aware of the options is because of the rocket money, because people want to make like multiple 10x and multiple 100x, so they get to know of what is options. But actually, this multiple x, this kind of the rocket money do happen in the market, but only for some specific criteria under some specific circumstances. So in today's classes, we will talk about how do we make use of these conditions to achieve those skyrocket money. What is the basic theory and the underlying theory behind the rocket money? So if you stay together with me for these whole sections, for the whole lessons, you will get to know why there is a rocket money in the market and how do we achieve it, and what is the theory that back you up to execute such trading and investment. Okay, and then afterwards we also compare the rocket money style with the steady wealth accumulation style, which they have pros and cons. And the skyrocket part, you might have a lower winning rate, but you get to have a very huge income and again at some specific timing. But the steady wealth accumulation part, you get to earn a very stable income using options, but you are not risking too much to the market. And there are pros and cons, and then I will just talk about how do we achieve both and what is the condition that make those two scenarios happen. So we will just make use of this option to achieve both result, which is skyrocket money and also the steady wealth accumulation. So whatever style that you are preferring, you can just referring to the you can just follow together along the class, and then I'll just talk into the detail, and you can make your decision. Either you want to go with the skyrocket one or the wealth steady accumulation one. It's all up to you. It's because of everyone have a very different risk tolerance and the preference. Me personally, I will choose to have a very stable and steady wealth accumulation because the skyrocket one, you might need to have a very strong mentality to just stay along to the market. So you need to try very hard to just get the success rate, to just try to get the one success that make you a very huge fortune. And but for the steady wealth accumulation part is a different story. I get to have a very stable mentality because my win rate is higher when you're comparing to the skyrocket one. The skyrocket one is like a lottery. Normally we didn't get the prize, but once we get the prize, it will be a huge bag for us. But personally, I would prefer the steady wealth accumulation one. And it will help me to just have stabilized my mentality and also to just gain the income very consistent from the market. Okay, so we'll just go into the class, and now we are going to talk about the skyrocket one first. So rocket money actually do happen in the market, especially in the options market. It's very common to see on every Friday, especially Friday, because when the option is going to expire, it's normally the rocket money happen, and the option usually expire on Friday. So the skyrocket money happen on every Friday. So if you are the type that favor the rocket money one, you can just do your trade on every Friday, and then the other day you can just rest well and then just to accumulate your bullets, and then you just shoot all those ones every Friday. But please be aware that you only trade for those options have a very high liquidity, because when the option is going to expire, even though the volatility is very high, it can go up very high or you can drop very steeply, but you need to be aware of the liquidity because it's the last day of the option trading. So you might need to worry that if there is anyone able to take your portion from the market. So which means that even though you buy into the positions, when you want to get out, is there any buyer willing to buy from you? So that is the cons of the rocket money. You need to be aware of the liquidity. Okay, so in the rocket money one, actually we are trading an option that is going to expire, and you can see that it goes from $1 to $10 is very easy. It's a very common practice in the market. Meanwhile, you can also see that it goes from 100x or even better, 500x. It might be surprising, but actually this is all normal to the market. Okay, so let's talk on this. I captured this Tesla option contract that is going to expire on this year, November 15. And this is a call contract that is on the strike price of 360. And then you can see that it goes from 0.078 to $15.77, which make a 20,000 returns for the whole upright. And you can see that afterward it dropped down and it consolidate at the bottom. After that, it consolidate in the bottom and then it rise again and achieve a 488%. So you can see that actually in the option financial market, you can see that 100x, a multiple thousand x is very common. So even though you miss the first ride, the 20,000 one, you can able to get on the second ride, a 488%, which if you invest $100, you can able to get back on 488. If you invest $1,000, that will be $4,088. It's very surprising when you're comparing to the normal traditional stock market. So actually, this kind of rally is very common in the options market. So even though you miss on the first one, the 20,000 one, and somehow the worst you miss on the second one, the 488%. Now there's the last one. It comes back down again to $0.06, the 6 cents options, and then it go up in just few days to achieve 27,000%, which is ridiculous. If you invest a $100 into it, then how much are you going to get? 27,000 back, which is ridiculous. And among all these three types, you can see that the duration that they take to achieve those returns are actually different. The first one, it takes about 90 days, which is 3 months to achieve a $20,000 return. And the second one, it takes about one month and a half to achieve a 4.58x. And the last one is even more crazy. It takes only 1 week's time to achieve a 27,000%. And among all three of those, which one are you preferring? Me personally, I would prefer the last one because it takes the minimum time to achieve a maximum return when comparing to the other two. So we will just talk on, in this class, we'll just talk on what is the basic theory behind the last one, the last scenario, which is the 27,000% in 7 days in just 1 week time. What is the underlying theory that back it up, and what is the condition that make that happen? And when it comparing to the other two, actually the theory behind is slightly different. It's because of even though they are in the same option, but the expiration date is different. So the time decay also affecting the options value. So in this case, in this scenario, we only talk about the last one, because last one is where we usually get the rocket money. So you do bear in mind that actually the last situations, the 27% do happen in the market, especially every Thursday and also Friday, because Friday is usually the expiration date, and usually when it is close to the expiration, the time decay is at the maximum level, which means your options will be at the lowest part. So whatever happened to the share itself will affect the leverage to the maximum. Okay, so now we'll just talk into the detail on how do we achieve a rocket money. Actually, it's very simple. If you want to become a very high return in the market, first of all, the cost need to be minimum, because if $100 flip into $200, this is just double. But if $1 able to flip into $200, then that will be different story. So you can see the difference. The cost that you get in the first situation is $100, and the second situation is the cost that you get in is $1. Even though the final result is still $200, you can see that the profit that you gain based on the cost that you pay is different. The first one only achieve a double return, and the second get to achieve a 200x. So if you put on the same costs to the second case scenario, the $1 flip to the $200. If you put in 100 into that $1 positions, then it can flip into 20,000. It's very ridiculous result. So do bear in mind that you need to, if you want to achieve a very high return, you need to make sure that the cost is at the minimum. So the leverage will be at the maximum. It's both related. So yeah, we will just talk on how do we able to achieve a very low cost, and how do we achieve the lowest cost in the market. Actually, in the option world, the cost is actually equivalent to the premium that we pay. So in the previous class, we have talked about what is the factor that affecting the premium value. And in this case, the premium value is actually very simple. The calculation is just that it's equal to the in value add on the time value. And what is the in value and the time value? We will go into the example. Okay, this is the real cases of Palantir in the uSMART interface. And then you can see that in this case, you can see the quote on the right upper corner. And when we enlarge it, you can see that for now, we list down all the information first. The premium value equal to the in value add on the time value. And the Palantir share is placed on $60.24. And in this case, the option that we observing are actually having a strike price of $60. And you can check on the in value from the quote. The in value of 24 cents is actually calculated by using the strike value and also the share price. How does we calculate it? It's actually equaling to the share price minus the strike price. So by using a $60.24, deduct the $60 strike price, we will be able to get the in value of 24 cents. So please bear in mind that in value equivalent to the share price minus the strike price, which means in value is how much is this option worth. So as long as this is in the market, it only has some in value in. If this is out the market, which the strike price is far above the share price, which means your option is now unable to execute. If this is unable to execute, then it doesn't have any in value. Okay, so the time value here is actually $1.65. And you can see that this time value vary across different strike price. And now we have the in value and the time value. We're able to calculate the premium. Let's check on is this calculation correct or not. With the in value of 24 cents, we calculate by deducting from the share price deduct by the strike price, we get the 24 cents in value. Add on the time value of $1.65, we're able to get $1.89, which equivalent to the premium. Now we prove that this calculation is correct, and we will utilize this theory to get us the minimum costs so that we can use the minimum costs to flip the revenue even greater. Okay, so now let's look at this options is going to expire in 3 days, and we will just check on the strike price, and we will go through the strike price one by one to just calculate the in value and the time value. Okay, so this is the strike price, and this will be the in value. Since in value is using the share price deduct the strike price, so the in value, you can see that for those price that is falling below the share price, which is $60.24, only have the in value. And for those which is far above the current share price of $60.24, doesn't have any in value, because those options are unable to execute right away. So it doesn't have any in value. So you can see the in value actually decreasing when the strike price increase. And now you know that if we want to minimize our premium, which is our cost, we need to choose those options which is out the money, because those options have the minimum value in value when comparing to the others. So the first step to minimize our cost is to choose the out the money options. Okay, now we already settled for the in value part, and we just check on the time value. So for the time value, this is the chart I taken from the previous classes with you talk about the data and time effect. And if you are unaware of the knowledge, you can just check back on the recording. And for the green line is actually the option is going to expire in 30 days, which is 1 month. And the blue line is actually the options going to expire in 90 days, which is 3 months. And you can see that from the blue line, the time decay at the beginning actually very slow when comparing to the one that is going to expire in 1 month. So along to the time decay actually accelerating, and at the last 30 days, the acceleration will achieve a maximum rate. And how do we able to get the minimum time value? The answer is we only target those options that is going to expire soon. So in this case, I will say that any option that's going to expire within 1 week is count to be the options with the lowest time value. Especially if there is option that's going to expire for today, then today the options time value will be at the minimum. So this is the time decay theory, which initially the bubble will be the time value, and the core, the blue circles will be the in value. And we can see that when it is far from the expiration, the time value will be very big when you're comparing to the near expiration one. So even though the in value doesn't change any in this case, the time value actually just decay along the time. So I will just make a comparison so you have a very better understanding on this. For the first one, even in these two bubbles, the first one is the one that is going to have a further expiration date, and the second one is going to expire soon. So the first one will have a bigger time value of 10, and the second have a lower time value of 2. The first one is the further expiration options, and the second one is the options that are going to expire soon. Okay, so in this case, even though they share the same in value, but the time value is different. So when the share price fluctuated, so when the share price increase, the in value actually increase. And what will we make to the difference to those two options? In this case, when the core, the blue circle increase, you can see the difference. The first one, even though the in value also increased from 2 to 4, and the second also increased from 2 to 4, you can see the gain from it is different, because in total it get from 12 to 14, which is a 16% increase, a 16% gain. Meanwhile, for the second one, it go from 4 to 6, which is a 50% increase in the total value. So in this case, we already know that even though the share price increase, the same in value increase happen on those two options, but the one with a lower time value, the one that is going to expire soon, the smaller bubble, will able to enjoy a greater gain when you compare it to the one that have a bigger bubble. So this is why people usually tend to just trade for those have they are going to expire in 1 or 2 days because the bubble will be at the minimum. Now, we already know about how do we calculate the in value, and we already know about the basic theory of time value. And if you want to minimize the cost, we want to minimize the premium value, what do we do? For the first one, the in value, we will choose the out the money options, because for those out the money option, it unable to execute right away, so it doesn't have any in value. So the in value will be 0. So the cost, the premium will only become the time value. And now we only have the time value left. How do we get the minimum time value? It's actually choosing the one that is near the expiration. When it is close to the expiration date, the bubble, which is the time decay, is at a maximum. So the time value will also at a minimum. So I'm going very slowly so to make sure that all of you understand. Now we already achieved the first condition, which is minimize the costs. And now we will just talk on how do we utilize it to achieve a rocket money in the market. So this type of options is also called the near expiration options or the expiring option, which we have a specific terms in Chinese, which is called 末日期权, which means that it is going to expire, usually referring to those options that is going to expiring in 1 to 2 days. And people tend to trade this kind of options because it gives them a very gambling, exciting emotions when they are involving in these kind of things. So now let's check on these cases, Palantir cases, and first of all, we will just check on the average true range. What does the average true range mean? In this case, the average true range is using the default parameter of 14 days, which means that it is calculating the past 14 days, which is the past 2 weeks time. Every day movement is having how many dollar movement. So when it is calculating the previous 2 weeks time, every day will have around 2.36 dollar movement, either up or down. So in this case, we're able to know that for Palantir, this stock itself, for now, the trend and the momentum, this stock will tend to move $2.36 in 1 day. Okay, so why do we need this information? Because this will help us to have a better calculations on the in value, because the in value is calculated by deducting from the share price, deduct the strike price. So we will need to know in future how the share price will move, so we can just predict what will be the outcome of this trading and investment. Okay, so in this case, we check on the Palantir options, and the first option is going to expiring on 2024 November 15, which is 2 days left from the time that I capture. And Palantir is falling on the price of $59.85. Okay, here you can see the expiration date, and also the number in the bracket is actually the remaining time until expiration. So for your better understanding, you can just choosing the minimum value in the bracket. That means it have the smallest, the minimum costs. So in this case, the current share price fall on $59.85. Now we already know that for every day, how many movement of the dollar movement it will have, because we have the ATR calculated by the previous 2 weeks time. So now we are trading the option that is going to expire in 2 days. And we can know that in the first day, this will be the range that it can achieve. Either it goes up by $2.36 to 62.221, or it goes down by $2.36 to 57.49. And further on, if the ATR remains the same, this will be the movement that it can achieve in 2 days. Either it can go up to the 64.57 cents for the greater returns, or it can drop to $55.13 if the worst case happen, which it dropped consecutively 2 days. Okay, so we already know the range and how do we utilize it in the options calculation. So let's get back on the option interface. And for the first case, we want to check on the call option first, which means if this option going to go up by today from $59.85 to $62.21, and what will happen to the value of the call options. So now let's take a look at the call options. Okay, so now you can see for the current call options, the in value will be all 0 because we are choosing the out the money options, which have the minimum in value because these are unable to execute right away. The current price is $59.85, so we are buying the call options with a greater strike price. We are unable to execute right away, so the in value will be at the minimum of 0. So the premium will be equivalent to the time value. In this case, I will just copy it left and right, so you can just see that the premium actually equaling to the time value. So what happened if this Palantir goes up by $2.36 by today? So if it goes up $2.36, and there will be a 3.94% gain from the stock, and the in value will be different because the share price will be affecting the in value. In value calculated by using the share price minus the strike price. So now some of those are affecting and having an in value instead. And you can see that if it goes up to $62.21, the in value will become something like this: 2.21, 1.21, and 0.21. It's a very simple calculation. So yeah, I'll just leave there as well. And then now the premium will become $3.58 for the option with a strike price of 60, and with the strike price of 761, the premium will rise to $2.14 when comparing to the initial premium of just 93 cents. And the third one, that the premium will increase from 64 cents to 85 cents. Meanwhile, the other two doesn't affect because the in value doesn't change any, and it's still out the money, so the in value doesn't have any in value. And you can see that the gain from the option is actually way greater when comparing to the stock movement. The stock movement only have a 3.94% gain. Meanwhile, the minimum gain from the options with strike price of 62 is having a 33% gain, and the nearer one will have a 161% gain. And we can see that the closer the strike price to the current share price, it's actually having a greater gain, the greater leverage in the market, because the easier that the strike price get into the in value conditions, the in value effect will be greater. Okay, so this is the case if Palantir goes up by today. What if Palantir isn't goes up but it comes down? So in this case, if it comes down with $2.36 to $57.49, we will need to check on the out the money put options, which is the one in the yellow box. So I will just capture this yellow box, which have a strike price of $55 across until $59. So in this case, it's still the same. I capture it from the yellow box, and you can see that with the strike price of 55, it's having a $0.16 of premium, which is 16 cents premium. And with the maximum premium that you pay for the other money put options will be the options with 59 strike price, and the premium that you pay is 97 cents. So since this is still the out the money put options, there will be no in value. If you want to know more about put value, you can check on to the first class or the second class to have a better understanding. Okay, so if the case that Palantir is dropping, it have a drop of $2.36, which is the same percentage drop when comparing to the gain to the rise. Now there will be in value for the bottom two, which we calculate by using the difference between the strike price and the share price. Now you can see that the premium for the top three row actually remain the same, but for those two at the bottom, it actually have a gain of 81% and also 157% gain. So it's still we can observe the pattern there, which is when the strike price is getting close to the current market price, which means that the probability that it get into in value from out the money become in the money is greater. It's actually having the greater leverage benefit. So if we are going to choose for the options that is going to expire, how do we choose? The first criteria is it need to be out the money, and the second one is the option that we choose enjoy the maximum leverage, which is in this case the one that is closer to the current market price. Okay, so if you are going to trade for these Palantir options, these two will be your better choice. If it no matter it goes up or goes down. Actually, there's someone that is trading this kind of option. They just bought into these two positions together. They bought in the call options and also the put option together, so that no matter the price flirt, it also can win on one position and have and maybe the win can able to cover the cost for another position. So they're actually doing this kind of thing just to make a gain from one side, and it can just cover for the losses on the second side. So it's a very common practice, which this strategy is also called the straddle, which we buy into the call options and put option together, but in this case with a different price. What is the cons of trading this kind of options, which is going to expiring soon? The first one is liquidity. Since I already mentioned at the beginning, this kind of options are going to expire in 1 to 2 days. So normally people already get out of the position. So the remaining positions for this, the remaining players in the market is actually very limited, especially for those shares that have a very limited market cap, have a smaller market cap, which is unlikely to have a very active trading volume. There's actually very minimum liquidity in the market, and there's a chance that once you get into the options and you make a gain, but you are unable to escape from your position, you are unable to take the profit out of the market because there's no one going to buy from you. So the first one is liquidity. Before you get into the options, you need to check on the liquidity, and we'll really talk about the liquidity, how to check on the liquidity for the stock and also the option in the last class, which with the title of the first step to make money, which is to choose the stock and the options. And we have talked about how do we put on the filters and how do we screen for the option that have a very good liquidity from open interest and also the trading volume. So if you are unaware of how do we check on the liquidity, you can check on the previous classes that we talk about. The first step of making money, choosing the asset, and the options. And the second is there's no room for time, which means that when you are buying into this kind of option that's going to expiring soon, the problem is that it's going to expiring in 1 to 2 days. So you need the price to move within 1 to 2 days. There is no time left for you to wait for the price to react. This is what does it mean. Okay. So now we already talk about the rocket money style, and now we were going to talk about the steady wealth accumulation style. So once you get to know about these two type of trading pattern, these two type of trading style, you can decide on which type are you going to trade, which type fit you the most. Because the previous type you can achieve like 27,000 percentage profit in 7 days, right? 1 week's time you can flip $100 to 27,000, which is ridiculous, but it do happen in the market. And this is what we call the rocket money. We flip the money in a very quick manner, but this kind of steady wealth accumulation style, it might be different. And if you doesn't have a very big heart to induce those kind of fluctuations, the volatility, this kind of method maybe fit you the most. So for the steady wealth, actually we'll just do the buy low and sell high. So it's just like normal trading in the stock market, but in these kind of situations, we replace the normal trading method with a selling options. When we sell the options, we get the premium, and that premium is what we call a steady wealth. And I'll explain why it is steady and why I call this a steady wealth accumulation. And we have go through this kind of method in detail in the second class, which is talk about the beauty of being a seller. If you are very interested in the detail, you can just check onto the second class recording. So we are going to replace the traditional buy and sell in the market with a sell put for a buy low, and replace the sell high with a sell call. Okay, so before we get into any position, we'll get to sell put first. So if the sell put get to execute, we can buy low. So if after we buy low, we have 100 share of the asset, we will do the sell call, which is what we call a cover call. When we do a cover call, we get to earn the premium, and once it's executed, we're able to sell 100 share of assets on our hand back to the market. So in this case, we achieve a buy low sell high on the stock. Meanwhile, the selling in option also give us a very good return in premium. Okay, so this is still a Palantir options, and in this case, we are referring to the Palantir option that is going to expire on 2024, December 27. Not the one that is going to expiring soon, but the one that is going to expiring in 1 month's time, between 1 to 2 months time. Okay. So I include the delta because we already explained what is the delta in the lesson 4, the Greek's value, and delta is also what we call the winning rate in the market. So market usually understand the delta in a way that it represents the possibility that the out the money options to become in the money options at the expiration date. So which means in a simple human language way, this delta equal to the winning rate of the options to be profit at the expiration date. So it equal to the winning rate of the options to be profit at the expiration. Okay, now we already understand delta equal to the winning rate on the buyer side. So now we are actually on the seller side, and at the seller side, the winning rate actually is on the opposite to the buyer side. So in this case, we will want to ensure that we have a higher win rate when comparing to the normal situations. This is what we do. Personally, I will going to choose the delta with around 20, 0.2 to 0.3, which means that for the buyer, it will have a 20 to 30% win rate. So to the seller, we will have a 70 to 80 win rate, 80% win rate, which is a very high win rate if you're referring to my risk tolerance. So in this case, if we don't want the option to get filled and we want to enjoy the excitement of just collecting the premium consistently, we tend to choose those that is having a very high win rate. So in this case, choosing a lower delta can avoid being executed. Okay, so in this case, for the first one, the sell put, I choose the one with a delta of negative 0.2. So the buyer will have a 20% win rate and the seller have a 80% win rate. And after that, we can choose to sell the call, and the sell call that we are going to choose is the one with a delta of 0.267, which means that the buyer have a 26.7% win rate and the seller will have a 73.3% win rate. Okay, so now I already state down the win rate, which means in both situations we have a higher win rate, and this is the price that is traded recently, and the price is with the sell put, the premium is having the premium of the sell put will be $1.35, and also the premium for the sell call will have a premium of $1.79. When one option equivalent to 100 share, this is the premium that you are going to collect. For the sell put is 135 and the sell call is 179. So in this case, Palantir actually fall on the current share price of 59. The delta suggests us to buy low at 53. So the current share price 59. It suggests us to buy on 53. Later on, it suggests us to sell on 70. This is the two price that suggested by the delta, which have a higher win rate for the seller, which means that this is unlikely for the price of 59 to drop to 53, and afterward it is unlikely for the 59 to rise to 70. It tends to just trap in between this zone, between 53 and 70. So the price of 59 will just float in between. This is how we understand the delta. And in this case, we will need to prepare, since we are in the selling position, and when we are doing the sell put, we will need to ensure that we have the enough money to execute. So we will need to ensure that we have a collateral of 100 share of the strike price. When the strike price, because when it fall into $59, we will need to buy 100 share from the buyer. So we will need to ensure that we have a collateral of 5,300 on hand, and afterwards we need to ensure that we have 100 share of this Palantir to execute the sell call. Please be aware that a naked sell position is very dangerous, and we only do this to just replace the traditional buy low and sell high to make extra money from the premium. So please do not do the dangerous movement, which is you do it without collateral, you do a naked sell position. So in this case, you can see that we have a buy low and sell high, and then we collect an extra premium of 135, add on the premium of 179, which we collect in extra. So how do we understand this? The winning rate of 80%, which means that if you execute 10 times of selling puts, only 2 times of those will be executed, and the other 8 times you will just collect the premium without being executed. That is how we understand. So if you collect those 8 times of the premium 135, you can just collect way too many money when comparing to the initial capital that required to buy on the share. So This is also the most favorite method used by Warren Buffett when you want to get into the position. The greater the position that you want to get in, the greater the premium that we will receive. Since this is extra money, why don't we do that? So now these two will be the method that I will be introducing today to get a skyrocket money and also to generate a very steady wealth. So which kind of the method that you're preferring? You need to decide based on your risk tolerance. And here comes the end of our sessions. And this is my personal VCom. You can just contact me. And if you have any questions, feel free to ask me, and I will just ensure to answer you if I have any available time. And in the next week, we are going to discuss about my personal key concept of how to be profitable. Because initially I'm lost in the market, which I lose the money and I don't know the way to make profit from the market until I realize this key concept, which is simplicity. Because even though we learn a lot and we doesn't master it, it doesn't help. So when you're comparing to just learning everything, master 1 to 2 skill will be enough for you to just generate a very good income from the market. And second on, we will talk on different style of trading options. The first one is we do it the theory way, which we buy on the options and wait until the executions. And we have the P&L from the price difference in the share. And the second is what we normally practice in the market, which we usually buy on the options and we didn't wait until execution. We will just sell it back to the market to get the difference in the premium. So the first one is execute and get the profit from the share. And the second is we do not execute and get the profit from the premium. We will talk on to the details of these two types of trading style in next Friday class. So make sure you join us on next Friday class. If you have any questions, feel free to ask, else I will just end for today's sections. Before we end for today's sections, I will just introduce you the benefit of opening a uSMART account right now. If you open a uSMART account right now, you're able to get a benefit of 0.202 share of Tesla. And if you deposit more money into your account, you're able to get more cash voucher. And if you are interested into opening an account in uSMART and want to start on your trading journey, feel free to register through this QR, and I will guide you all through all of those. And we will just make it from a beginner to become a financial expert and make some money from market together. So if there's no more question from all of you, we will just end for today's sections. And before we end for today's sections, I will just go into the disclaimer, just to avoid any unnecessary trouble. Okay, thank you all for joining, and I hope you guys have a very good weekend, and hope to see you guys on next class. Appreciate your time and happy weekend. Thank you.